Good morning, everyone. This is Financial Literacy 101. And today we're going to talk about the difference between an ETF, which is an exchange traded fund, and a mutual fund. Okay. The reason why we're going to go over the ETFs and mutual funds rather than doing a stock review today is because if you notice, right, the markets are absolutely going crazy because the increase of not only people contracting and reported COVID-19 cases, okay, not the increase of those rates, but also the deaths, okay? So even with the drug Remycin, I believe that's the name of it, we're still having a great number of Americans dying from this virus from throughout this pandemic. So today the market is doing fairly well and we can still invest, but we do need to safeguard. We need to allocate. We need to diversify some of our funds because we're going to understand we're going to have huge fluctuations in the market, And the number one thing we absolutely want to do is to make sure we're what? Well diversified, okay? You want to be in stocks. You want to be in bonds. You want to be in index funds. You want to be in ETFs. And of course, if you know anything about me, you definitely do not want to be in mutual funds. And that is what this video today is about, is giving you guys the information of not getting into mutual funds, okay? Not getting into mutual funds. So the first thing I'll go over is just a little bit history about the mutual fund as well as the ETF, also known as the exchange traded fund, okay? So I'm gonna share my screen with you guys really quickly. Here we go. Let's get a little bit. Just 1 year, in just 1 year. That's what occurred in just 1 year. I wonder why. Okay, so if you know anything about ETFs and you know anything about mutual funds, the major difference, I'll just let the cat out the bag, the major difference in between the two funds. Now, first of all, let's understand the construction of a mutual fund and an ETF. A mutual fund and an ETF both contain a basket of different stocks, okay? They're usually in the same sector. Let's take, for instance, financial institutions. Let's take some banks. So in one mutual fund or one ETF, you'll have Capital One, USAA, Navy Federal, JP Morgan Chase, Bank of America, and you know, all other sorts of types of banks will be inside of that one fund. So when you are investing in one fund, you are investing in those different stocks and those different corporations, okay? So when one particular stock in that fund does badly, but the other ones outperform, your risk and your volatility is a lot lower because you're still making money. Okay, let's take another example of a mutual fund or ETF. Again, it's a fund because it contains a basket of different stocks, usually in the same industry. Okay, usually in the same industry. Let's take, for instance, if it was gas or oil, okay, you'd be Texaco, Chevron, Exxon, Quick Trip, what's another big one? Shell, etc. So you'll be essentially investing in all of those at the exact same time, but in fractions. But the good thing about that is your risk is lower, but also a lot of your returns. But with ETFs and mutual funds, you do have consistency. So over the course of the stock market, which some people contribute the stock market being started back in, I believe it was 1851. Don't quote me on this. 1851 back in Belgium, they started the stock market. So don't quote me. Could be slightly off, but when we first started, I think of investing inside of corporations and also organizations to give them more capital to be more innovative. This was the way of the future because you can get a return of the money that you put up instead of it being a loan. It's an investment. So that's a big difference we need to understand. Whether you are investing in a singular stock, right? So you're like, oh, I just love Tesla. So you invest all your money in Tesla. But if Tesla does poorly, if Tesla does bad, if Tesla just autonomously drives itself and you're like, I didn't put anything inside of it. I don't know why the car is going crazy, okay? That means that one fatal flaw could cause that particular stock price to plummet. But what if you have Tesla, NIO, Rivian, BMW electric car, Mercedes electric car, and they're doing fairly well? Yeah, your portfolio would take a small, but it would still increase in money and also value because those other stocks are doing well. So your risk is a lot lower because you are investing in more than one company. So that's the glory. So during this really shaky, rocky, volatile stock market because of this pandemic, if I were you, I would really start to, adjust my allocations more over to ETFs and index funds and bonds versus on a higher end doing individual and international individual stocks. But let's get back to it. Okay, let's get back to it. So we talked about when mutual funds first started. Let's go over to ETFs. Okay, let's go over to ETFs. The world, and that's what we need to understand, that exchange traded funds are fairly new because mutual funds started back in 1924, ETF started back in 1990, and one of the big hallmarks, one of the big names in this industry when it comes to ETFs and index funds is Jack Bogle, the one CEO. He passed away recently, I believe it was last year. He was the CEO and founder of Vanguard. He made them very, very popular. And believe it or not, ladies and gentlemen, he made a lot of people a lot of money. Okay. I stand by ETFs and index funds, but today we're talking about ETFs and mutual funds. And again, the biggest takeaway before I get into the information and some of the details is that mutual funds are actively managed. ETFs are passively managed. And your question is, what does that mean? So this is exactly what it means. So take, for instance, you have a stockbroker. He said, hey, I'm going to set you up on some mutual funds. You go, oh, great. I heard great things about mutual funds. I know that I can invest in many stocks at one time. But what they don't tell you about mutual funds is there's so many darn hidden fees. So let's say for the past 10 years, and this is the truth, for the past 10 years, mutual funds, ETFs funds, index funds has been doing anywhere between 7 and 15%. I know it's a long range because it just depends on which fund you're in. But let's say 7 to 15%. But the big difference is with actively managed mutual funds, there's two things that are killing your returns. Two things: hidden fees and taxes. Hidden fees and taxes. Now, first, let's get about taxes. Uncle Sam gonna get his money. That's just what it is. Uncle Sam is going to get his money. But the reason why it's a huge hindrance to your stock portfolio is because every time that stockbroker tries to beat the market, and that's what mutual funds try to do. You have a stockbroker, you have an investor, he's moving stocks in and out of your funds, okay? In and out of your funds, trying to beat the market returns. Every transaction he's making, he's incurring some sort of tax. Some sort of tax. The more transaction, the more tax. The more transaction, the more tax. That's the first one. Then secondly, all the hidden fees that are attached to mutual funds. I give you a good book to read, Unshakable by Tony Robbins. Read that book, Unshakable by Tony Robbins. He will tell you and break down all of the hidden fees inside of mutual funds. Because because it's actively managed, meaning someone is actively always working on that mutual fund. They're getting a commission price, usually at 1%, 1 to 2%. And let me tell you right now, ladies and gentlemen, ETFs, index funds, don't get nearly close to 1% for the expense. The expense is the amount of money that you pay. And some of you are saying, well, if I'm getting 10% and someone's taking 1%, then that's not a lot of money for him or her to do their job. My question to you would be, do you actually know what 1% dealing with that fund? 2, why pay someone to do something where another organization or another fund would take fractions of a dollar versus you getting 10? So that is the kind of the thing you really have to think about when you're trying to pick. When someone is trying to put you into a mutual fund, like, man, we've been doing mutual funds for a very long time here. We're really great at it. We're experts. All of our customers, they receive 15%. Yeah, they may receive 15%, but what do they actually receive in their accounts? The stockbroker get their money, all the hidden fees, the kickbacks to the company. Here's another thing, 401k. 401k is another form of a mutual fund. And I'm 50-50 when it comes to mutual funds when it's dealing with 401ks, because if some people don't do a 401k, most people just won't invest. They just won't invest. It's easy because it's through your corporation. It's easy because it's between your organization. Okay, let's get into some details of the two differences. I got some notes here. So again, mutual funds are actively managed. ETFs are passively managed. Okay, so mutual funds usually are actively managed to buy or sell assets, that's stocks, within the fund in an attempt to beat the market and help investors profit. Where ETFs are mostly passively managed, as they typically track a particular market index. They can be bought and sold like stocks. That's the great thing. Okay, so let's move right along, because there are 3 kinds of ETFs, which are open index mutual funds, unit investment trust, and grantor trust. But I don't want to even get you confused when it comes to that, because that is not the big takeaway here. Excuse me. Now, here's a kicker. When you get into a mutual fund, they usually have a higher minimum investment requirement. Take, for instance, if you go into Vanguard, which I love investing with them. I used to invest with them. I don't believe I have any more. I might have a couple of thousand there. I don't recall. But to get into one of their mutual funds, it's called the Vanguard 500 Index Investor Fund. It requires a minimum payment of $3,000. Now, some of you may have $3,000 and some of you may not have $3,000, but automatically getting inside of that particular fund, you have to pay $3,000. $3,000. Okay, it says, while the Growth Fund of America offered by American funds require a $250 initial deposit. Many mutual funds are actively managed by a fund manager or a team making decisions to buy and sell stocks or other securities within the fund in order to beat the market and help their investors profit. These funds usually come at a higher cost since they require a lot more time, effort, and manpower. See, people are working on your behalf in order to get a higher return of investment, a higher profit, but you got to pay. You have to pay. And if you did the math, ladies and gentlemen, you say, you know what, I'm just going to put my money into an ETF. Because ETFs are outperforming mutual funds when you take away the amount that they actually subtract from the percentage that you have gained from them managing your account. That is what you need to understand. Now, there's 2 types of mutual funds. You have the open-ended and you have the closed-ended. But we're not getting to those vivid details. We're just getting to the basic which one is good for me? And I'm gonna tell you right now, right off, if you're like, hey, I'm in, I'm out today, I don't have a long time to see a long video, you might want to go and look into ETF funds. And a good source for that, if you look in the description below, Stash. Stash is a great way. The only take back, the only con to Stash of ETF funds is they charge a minimum amount of money a month. Now, if I recall correctly, if anyone in the chat, I believe if you're below $5,000 in your portfolio, it's $1 a month. If you are above that amount, if you're above that amount, it's 0.25% of the amount. Okay, I could be slightly off on that amount, but nonetheless, Stash is a great way. And you also have WeBull, you have Robinhood, and you also have M1 Finance to invest. Okay, and now that WeBull and also Robinhood are doing fractional investments, if an ETF costs $150, you can still invest $3 inside of it and still make money. Okay, you don't have to invest the full $150, if you know what I'm talking about. All right, let's get into ETFs. ETFs can cost far less for an entry position, as little as the cost of one share plus fees or commission. An ETF is created or redeemed in large lots by institutional investors, and the shares trade throughout the day between investors like a stock. Okay, like a stock, ETFs can be sold short. Those provisions are important to traders and speculators, but a little interest to long-term investors. But because ETFs are priced continually by the market, there is a potential for trading to take place at a price other than the true NAV. Let's look at some ETFs on Robinhood. Let's look at some ETFs. Someone is going to type in ETFs on Robinhood. We're going to go to one of the oldest ETFs. It pops up. It's called SPY. That is the ticker. That's SPY. It's a SPY S&P 500. And we're going to look at this very quickly. referring to these right here. Okay, when people are talking about to these right here, they're referring to the dividends that they're living off every single day. That's what they're talking about. So even though that the stock is down, you're still going to get your dividends. Because here's the thing. This is also, I want you to just take a moment and think about this. Ponder about this for a second. Why are you investing? Are you going to buy a lot of shares and then hold on to them? You're like, oh, it's going to increase in value. I'm making great money. Do you really make money, or are you holding on to money? See, there is a psychological connection that we have with money. So what you need to understand is you may have this money, but it's not your money because you didn't cash in on it. So essentially, if you buy even these particular ETFs, you're like, oh, they're not performing that great. Then I want you to perform on the dividends. Dividends pay out every 3 to 4 months, depending on the ETF. Every 3 to 4 months. So that's what you need to take note. Okay, let's look into 3 months. They're up 8.9%. Let's go into 1 year. They're down 7.40%. And then over 5 years, they're up 21%. I'm about to say, I can't do 3 in a row because I just become, wow. I was going to look bad there for a second. All right, let's move on. Let's look at some SPDRs. Let's look at the SPDR Gold Trust. Let's look at that one. Okay, that one's up 2.3%. Let's go to 1 year. 27%. And then over 5 years, it's almost up 60%. So again, you don't have to invest the entire $170. You can allocate $25 a month. Okay. Or what I like to tell people, try to invest $5 a day, which equals out to $150 a month. What equals out to $150 a month. That is absolutely great. And again, now this particular, because it's a trust, doesn't have any dividends. But let's move on. Fidelity, they have some ETFs. Let's look at them. You have the Fidelity MSCI Information Technology Index. Indexes are essentially can be ETFs and vice versa. That makes any sense. Okay. All right. This one only gives you 1% dividend, but let's go out to 1 year. It's up 31%. I mean, I'm rounding up. It's up 31%. And then for 5 years, let's look at it. Come on. 151%. I want you to think about that for a minute, ladies and gentlemen. If you would have invested in this stock 5 years ago, you would have paid $34, right? Because we were talking about 151% plus $50. So you would have invested at $30. For every share you would have bought at $34, you would have gained $50. You would have more than tripled your money. Okay, you would have got 100% of your return plus 50% more. Am I making sense here? Please let me know if I'm making sense here, because this is the power of investment. Okay, this is also what I love what Warren Buffett says. This is the power of patience. Just be patient. If you're making solid investment, the value of your portfolio will increase in value, which equals ching, 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 dollar signs. Dollar signs, okay? Dollar signs. All right. Let's look into some of you guys' notes. I know you've been talking to me. Good morning, Nolan Baptiste. Good morning, Clan Killer. Cleveland Cliff is next. Cleveland Cliff. I love to actually live go into stuff. Okay, I think I spelled Cleveland wrong. There we go. CLF is a ticker. So let's look into that very quickly. Now, let's read about it. Because see, what I don't want you guys to really focus on is the red. The red, you're like, oh, it's not doing that good. Stocks fluctuate in value throughout the market day, throughout the market week, throughout the market month, throughout the market year. That does not mean that this stock won't go up. Again, do your research. This is part of your research, okay? First of all, we have the line. We have the timeline. You got the day, the week, the month, the 3 month, 1 year, 5 year. You go to other platforms, they got kind of the same format, 3 years or all. Some of them just show all, okay? So let's go right to 3 months. 3 months, they have a return of 64%. Okay, here I go. You know I got to buy me some shares, guys. I just got to buy me some shares because let me finish. I'm not a, you know what they call it when you walk past an impulse, like an impulse buyer. You're like an impulse shopper. You're like, oh, that's a nice shirt. It's on sale. You don't need a nice shirt. You have 100 shirts that you haven't worn yet. You don't need this shirt. So don't become an impulse stock buyer. And the reason why I say I probably need to buy some is because we talked about the same stock very briefly last week and I passed on it, okay? But here it is still performing at a great rate. Let's look at it. 1 year. Now, after 1 year, it's down 50% essentially. So let's continue to dive into this because even though it's down, look at that. Over the course of 5 years, it's up 81%. So now we're going to dive a little bit deeper and we're going to read about this particular stock. Cleveland Cliffs, also called Cleveland Cliffs, is an iron ore mining company. It supplies iron ore pellets to the North American steel industry from miners and pellet plants located in Michigan and Minnesota. It operates through the following segments: mining and pelletizing and metallics. The mining and pelletizing segment owns operational iron ore mines plus indefinitely idle mine. The metallic segment constructs on HBI production plant in Toledo, Ohio. The company was founded in 1847 and is headquartered in Cleveland, Ohio. So this is a very, 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 very old company. So they look like they have really solid profit margins. They have over 2,300 employees. Over the past year, their stock price went up to $11.61, and then they've been down. So that's another part of research. When did they go down? Oh, how volatile is the stock? Let's see. The volume was around 13 million. The average value is around 13 million. The dividends, here's another dividend stock. So you can come in at a stock. And again, if you want to go back and learn about PE ratios, how we really break down a stock, go watch my video, okay, about the PE ratios, because the PE ratio has to do with the current stock price and also the EPS, the earnings per share. It allows you as another analytical tool to tell you if a stock is overvalued or undervalued, okay? And we only want to invest in what? Undervalued stocks. You never want to invest in overvalued stocks unless you're riding a wave, okay? That's what I call riding a wave. Now, riding a wave is the most dangerous form of investing. It's almost like day trading, but I call it riding a wave. Okay, YouTube, I'm coining this term. I never heard anybody say it. Riding the wave, meaning you're taking a gander, you're taking a chance, you're taking a gamble, okay, on a stock boostering up like Neo did that one day. It went up like 100, 200 points. You like buy. You see it start to decline, sell. You're riding the wave. It's like a surfer. You're like, oh, this is a good one. This is a wipe out. That's what we're talking about, riding the wave, okay? So again, let's look over the timeline and see how they're performing throughout the year. So, okay, 2017 looks like a good year. Let's look here and boom. COVID-19 is the biggest dip in this stock's decrease. Have you noticed? I want you to look at this line here. So let's expand this a little bit. Okay. It disappeared on me. Okay, there we go. So as we're looking at the timeline here, yeah, I got all of my analytical tools up here. Estimated movement average, volume, price of the stock. But where are we at? When we come right around here, okay, that's April, March time frame. That is when COVID, right around here, March, April time frame, as you can tell. Now, the reason why I love this grid, I want you to look at the white lines in the background. That is a great indication, even though that is going up and down through the volume, moving average, and even at the bottom, you see those bottom lines, you got the RSI Then you have the wildest RSI. The RSI is the relative strength index, which is another indicator analytical tool. Then you also have the grayed out in green and black. The green and red graph at the bottom here, right here in the background. All of these are tools working in your favor for you to understand how stock is performing. Now, granted, when we get right around here with a huge dip, and again, look at the background grid because it's going to give you a reference point of the other dips. Now, here we are fairly moving along. Now it's declining. They said, oh, there's a pandemic here. And they said, whoop. Then they said, okay, we got a great handle on the pandemic. And it's rocky, it's going up, and now we have more cases, now it's going down. But again, we are investing for the future. We are investing in the future. So this is probably a good time to buy Cleveland Cliffs. That's it for that one. I know we're talking about ETFs and mutual funds, but you got a little bit more for your money. Good morning, Nader. I hope everyone is having a great day. Hopefully you got some good information between mutual funds and ETFs. I'll just do a quick overview. Mutual funds, don't invest them in my opinion because they had a lot of hidden fees and they incur a lot of taxes because they are actively managed. The stockbrokers, the team of investors that created your mutual fund is always doing transactions. Meaning if you have a basket of stocks, they are always taking stocks out, always putting stocks in, which is calling a lot of taxes to incur. And all the while, they're getting their commission fees kicked back to organizations, and they're filling their pockets with a lot of fees and commission fees, hidden fees, etc. Now, ETFs and index funds are passively managed. And all what that means is once they pick a few stocks, they got 5 stocks in this fund. We're just gonna leave it. We're gonna let it ride out. We're not gonna change any in and out. We're not gonna incur any more taxes than we've already incurred when we first created that portfolio, that particular fund. So that is why they are very low taxed and they are consistent in their profit margins because they don't beat the market. They don't try to beat the market. They simply track the market. And when you track the market, you make money. There you have it, ladies and gentlemen. ETFs versus mutual funds. ETFs and index funds will kill, demolish, mutual funds every day, all day long. This is Financial Literacy 101. Learn money and be inspired. And if you're in a mutual fund, you might want to call your broker and say, hey, take your cut. Give me my money. I'm going to ETFs and index funds. You guys have a great day and be safe. I'm out.